UiPath stock is down 30% at the time of making this video. Yes, you heard it right. The company is losing now a third of its value after, well, the quarterly numbers were released. Now for this quarter, it's a double beat. Beat EPS estimates and beat revenue estimates. But as we have known for a while, just because one quarter is decent does not mean that your stock will not get hit. The problem here is guidance plus a change in management. So right now, one share will cost you $12.63. With regards to market cap, before they reported earnings, they had a market cap of just over $10.4 billion. Now, of course, it's going to be 30% less. Forward PE is also going to be lower. But if you look at all the other metrics right now, these will get updated, I think, tomorrow. Yes, the stock is down 30%, but don't focus on the numbers that you see here right now, the analyst estimates, because these will come down quite significantly since the new guidance that was provided by management is lower than what you see right here. Because right now, sales estimates for fiscal year 2025 sits at $1.56 billion, representing 19% year-over-year growth. But as you will see, guidance is going to be quite closer to what the analysts were estimating at the start of 2023, $1.45 billion. Now that said, of course, since you're down 30%, guidance is not a miss by 30%, then yes, the other metrics are going to come down. But in this type of environment, you would like to see this type of companies grow faster than expected, right? If they are experiencing a slowdown right now for one reason or another, plus weak guidance and a change in management, in this case, a new CEO, well, new old CEO, usually that doesn't really send the best of messages. Could be that maybe this becomes an acquisition target, especially now at a 30% decrease, right, in value, or there's truly something bad going on inside the business. Now we're going to have a look at the numbers in just a second. Of course, do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe. If you have not, want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's start off with a couple of comments here. We are pleased to report that ARR surpassed $1.5 billion in the first quarter of fiscal 2025, a testament to our market-leading business automation platform and the strategic role automation plays in digital transformation. We believe the foundation of our business remains strong, and we are optimistic about our ability to drive growth and profitability through improved execution, customer centricity, and continued innovation. So let's have a look at the numbers for this quarter. Revenue increased 16% year over year to $335 million. ARR reached $1.5 billion, increased 21% year over year, so that is increasing faster than overall revenue. Net new ARR of $44 million, dollar-based net retention rate of 118%. I believe last quarter was 119, still quite decent. GAAP gross margin was 83%, non-GAAP gross margin 86%, GAAP operating loss, of course, on a GAAP basis, still losing money. That's a loss of $49 million. Non-GAAP operating income, $50 million. Net cash flow from operations, $100 million. Non-GAAP adjusted free cash flow was $101 million. And the same as last quarter, cash equivalents, and marketable securities stayed at $1.9 billion. Now, the leadership changes. So, UiPath announced Rob Enslin is resigning as CEO and member of UiPath Board of Directors effective June 1st, 2024. Daniel Dines, founder and former CEO of UiPath, will be reappointed CEO, also effective June 1st. Dines currently serves as Chief Innovation Officer and Executive Chairman of the board. Now, like I said, a change of CEO, despite it being the founder and former CEO, mix that with some weakish guidance or worse than expected guidance, to me, that just doesn't sit right. Of course, the business will do the talking in the long run. Maybe we'll get some explanation during the earnings call or maybe tomorrow. But so far, that's all the info we've got. I will update you in the pinned comment. Then with regards to financial outlook, they already have here a small explanation why it is a bit weak-ish. So during the first quarter, we saw increased deal scrutiny and lengthening sales cycle for large multi-year deals. We have considered these factors, the current macroeconomic environment, and our leadership transition in our updated guidance for the remainder of the year. So maybe again, they are putting the bar lower so the new CEO can outperform. We've seen that with Snowflake, for example. While our revenue and operating margin guidance are impacted by contract timing and duration, we have confidence in our ability to generate durable ARR growth at scale and meaningful non-GAAP adjusted free cash flow. And so, for the second quarter, they expect revenue to be in the range of $300 to $305 million. The expectations were $342 million, so quite a big miss. ARR to be in the range of $1.543 billion to $1.548 billion. Non-GAAP operating income approximately break even. Then for the full year, they expect revenue to be in the range of $1.4 to $1.41 billion. The expectations were $1.56 billion, as we've seen at the start of this video. And here ARR is expected to be in the range of $1.66 to $1.665 billion, with non-GAAP operating income of approximately $145 million. Underneath all of that, they talk a little bit about their business highlights. So one of those, UiPath and Microsoft deepened partnership through integration with Copilot for Microsoft 365. Now, we've talked about UiPath in the past. They're still the leader in their field despite Microsoft and some other players out there. They're still the leader by quite a margin. Now, with regards to cost of revenue, total cost of revenue and total operating expenses, so total cost of revenue did increase 26.7% year over year, despite revenue just increasing 16% year over year. Total operating expenses increased 12.6% year over year, so that's increasing less than total revenue. But the cost of growing those revenues, well, most of the increase there comes from subscription services. They also did repurchase $22 million worth of stock this quarter. And so right now, if you look at this stock, of course, I believe it's going to be quite close, if not certainly oversold tomorrow if we stay at a decrease here of 30% in value, which means we're going back to levels not seen since May of 2023. So just over a year ago. Will we find support again? Remains to be seen, because back then you did not have that much bad news. Well, bad news, let's say uncertainty, bad guidance, or weaker than expected guidance, plus a new CEO. I mean, mix all of that and you've got some more pressure on such stocks. And just for information, the current average analyst price target sits at $27.63, which means that before they reported their earnings, the difference between the stock price and the average analyst price target was 52.43%. Of course, right now it's going to be over 100% difference, but I'm sure the analyst price targets will come down. This is just so you know, if you look at analyst price target and think that, oh, that's one of the reasons why the stock should go up. Well, this is one pure example of the analysts are wrong or did not see this coming. And so overall, right now you're getting a company that is 30% cheaper than just a few hours ago. Yes, it's true that guidance should have been better than what we were given. Yes, it's true that we could have not seen it coming, a change in CEO right now. So usually what happens is I would stay on the sidelines and wait and see until I get more and more information, whether it's through the earnings call or whether it's through other analyst conferences. My thesis, I don't hold the stock, but we've covered this stock previously on the channel, I believe not so long ago. The total addressable market, the market that they're playing in, all of that has not really changed. It all depends again on the simple thing is continued execution. If this new CEO or new old CEO can turn this around and can continue to execute and reaccelerate growth, make this truly a profitable company, then I think you're getting here bargain prices, right? 30% less than a few hours ago. Of course, it's never great to hear a change of management plus a big miss when it comes to guidance. So the stock gets hit quite hard. Of course, could be an overreaction. Could also be guidance that was sandbagged. Remains to be seen, but overall, that's why the stock is down so much. Do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.